Octopus Renewables Infrastructure Trust is a company that we IPO'd back in December 2019 on the back of a mandate to build a diversified portfolio of renewable energy assets across the UK, Europe and Australia. We've spent the past 5 years building that portfolio. We now have around about 41 assets and spanning 803 megawatts of generating capacity across 5 key markets.
So during calendar year 2024, we delivered a positive NAV total return of around 2.5%. And that was mostly driven by paying a dividend in line with the target that we set out at the start of the year. The net asset value did decline as the positive increase in value of the portfolio as we delivered accretive power purchase agreements and also successfully sold assets at premium to net asset value was offset by the capital that we returned to shareholders in the form of dividends and buybacks, and also by the running costs of the company. We paid out an on-target, fully covered dividend of 6.02 pence per share, the third year in a row that we'd increased the dividend in line with inflation. So it was a 4% increase on the prior year. And indeed, following the year end, we've announced a further inflation-linked increase in the dividend target for financial year 2025. So the fourth year in a row that the dividend target has been increased in line with inflation. Capital allocation has been a really important topic, and as part of that, in the middle of the year, we announced our first share buyback programme of £10 million initially. So during the second half of the year, that buyback programme delivered NAV per share accretion to investors of around half a pence per share. And in combination with the on-target dividend that we paid during 2024, we returned around 40 million of capital to shareholders. And indeed, since the end of the period, we've announced a further increase in that share buyback programme, so another 20 million, taking the total share buyback programme to £30 million.
We completed on all of our outstanding capital commitments, and principally that was the purchase of the Ballymacarney solar complex, which is strategically located just outside of Dublin. It's 199 megawatts spread across 4 individual sites. We completed the acquisition of that back in February. And then we subsequently bought the Harlexton project, which is a 5th site. It's an addition to that solar complex. In October, and that's an additional 42 megawatts for 241 megawatts in total. In terms of our capital recycling, we completed the sale of the Ljungbyholm wind farm for a total of 74 million euros. That was sold to a German international investor. And during the relatively short hold period, that delivered an 11.3% return for ORIT's investors. Another operational highlight was entering into a power purchase agreement with Sky for the offtake at the Crossdykes Wind Farm up in Scotland. So to underline our commitment to capital recycling, the sale of the Ljungbyholm wind farm means we've now realised £161 million of asset sales at a 12% uplift to holding value. And that means that ORIT has now sold more assets as a percentage of NAV than any of our listed peers in the renewable space.
The amount of generation that's come from our portfolio of assets has increased year on year by around 7%. And that's as a result of the new projects like the Breach Solar Farm coming through construction, as well as the acquisition of the Irish solar portfolio, offset by some of those asset sales, such as the Swedish asset Ljungbyholm. And we've been able to grow revenue and EBITDA by even more than that. And that's as a result of that active portfolio management. So the new projects that have come into operation have received a higher price for the electricity that they generate than the ones that we've sold. And also we've been able to reduce average operating costs so that our EBITDA margin has increased.
In the last couple of weeks, we've set out for investors 3 clear goals that we have for 2025. The first of those is our share buyback program, where we have extended the program by an additional £20 million. The second is our aim to reduce leverage in the company to below 40% of gross asset value. And then the third of those is to sell up to £80 million of asset sales.
So the acquisitions we've made most recently have been very much focused towards the developer side of things, which is an area where we can get higher returns for a relatively limited deployment of capital. And the 2 developers that we've chosen to support in Q1 are developers that we'd already supported and were in the portfolio already. The first of these was Nordic Renewables, or Nordic Generation, which is a platform focused on wind and solar primarily in Finland. And that portfolio has seen some really strong development in its pipeline. And so we're providing additional capital to allow them to bring more projects through and to take projects through to the next stages and eventually through to being ready to build. The second is BLC. Now, BLC are focused on developing solar with some battery storage in the UK. And there's a lot of change going on in the UK at the moment, particularly about reforming how projects access the grid. And the extra capital we've allocated to BLC will help them really accelerate their most furthest progressed projects and get them into the grid queue ahead of time.
We continue to see broad global momentum behind decarbonisation as a means of fighting climate change. And that's really reflected in government policy or supportive government policy across the various markets where we're active. And we continue to see corporates playing a key role in supporting new build renewable energy projects. Now, sometimes we see various policy and government rhetoric that might suggest a move away from renewables, but I think the reality is that renewable energy is the cheapest way to produce electrons. In Europe last year, 47% of all electricity came from renewables, and in the UK last year, more than 50% came from renewables.